The subject of my talk, to the extent it has a subject, is tis the season. I mean, as most of you that have been trading these stocks for any length of time goes, certainly not as much these days, but in the past there was a very strong seasonality, and the real speculation season for the resource business tended to be, basically mid-August to mid-December. This was back in the day when almost everything was northern projects, and guys were in the bush for 3 months, and really the reporting period was the autumn. I mean, that's the reason why things like PDC are in March, because back in the day, everybody was just coming off their vacations then, and there was time to do that before they went back in the bush. So, I mean, this year, it has a bit of that flavor again, in part because there are, in fact, a lot of northern project active this year, and a lot of the projects that are getting attention are northern season projects this year. So we're going to see, it looks to me like we'll have something a little more traditional, like what we saw in the past. There's lots of other things coming up behind that. It's not like we're going to have a 2-month window and that'll be it. But the next 2 months will be fairly strong. And of course, there's a couple of other things on outside markets, if you will, helping a bit. Finally, about 3 weeks ago, the gold price finally managed to claw its way through $1,300. And really, until almost the last minute, it was looking like it wasn't going to do that. It was looking like the third attempt in 6 months was going to fail. I know some of the other speakers spoke to it earlier today. I don't, at the time when it happened, I didn't see really a specific reason for it. I think it was just an overdue move, and I think because there were probably so many buy stops just above 1,300, because that's where it failed twice before. I think once there was enough volume to push it just through 1,300, you saw a lot of buying volume come in. And a lot of that was, in fact, I think, short covering. It was guys who were short, had set up buy stops there to protect themselves. So because you could see that day the volume really, really kicked in once it went through 1,300. The volume went way up, like you can see the spike there. And, it's managed to stay relatively comfortable at this level. Obviously, a lot of this move after the fact was political. As I think others have said this morning, and I heartily agree with, I hate political price moves in gold or anything else, because they tend to be ephemeral, they tend to end without notice, and it's just not a good thing if you're looking at longer term trading and investing. You don't really want to be trading based on stuff like that. I mean, besides which, who wants to be cheering on a nuclear war? It's a retarded idea. So obviously, that's not the reason we want to see the gold price go up. We want to see it go up because guys think it's cheap. That's the only reason I really want to see people buying it. We did see something similar at about the same time in copper and zinc, although I do want to say that I view these two markets differently. The copper market, again, there seemed to be a bit of a flood of liquidity into the sector in the broader commodity sense, because copper really had that strong move and then another strong move up right about the same time that gold went up and managed to get through 1,300. I view copper's move, even though you see something similar on the zinc chart, which is the chart on the right, I think copper's move was actually a lot more speculative, whereas zinc, I have no trouble seeing the supply demand there. That move made sense to me. Like, yeah, it's got to consolidate a bit, but I think it's probably going to go higher. Copper, yes, at some point it's going to go higher. I'm not convinced it's going to in the near term. To me, it really didn't make any sense that it ran that far. There's a few of the usual supply issues and hiccups that you always get in the mining business, but in an overall global sense of the market, we certainly don't have enough. There's not enough supply shortage that it would explain, to me anyway, the copper price doing that. So it's dropped back below $3, and I'm not personally going to be shocked if it doesn't see the high side of $3 in the near term, because there is supply coming on stream. I'm not worried about it. The copper price and the zinc price and the gold and the silver price, they're all high enough that if somebody has success, it will drive buying. We're not in a period now where the prices are so crappy and the market's been so crappy that somebody puts out a set of great drill holes and nobody cares. You do see that occasionally, but I think as some of the companies you've already heard from today and some of the guys out there in that room, there's 3 or 4 of them there that have put out great holes, and the market definitely paid attention. So, I think it's safe to say we're in a bull market. It's not a very broad one. This is the venture chart, which is a terrible chart, but it's the chart that I have. So As John Kaiser correctly pointed out, only about half the stocks on what's called the index these days are actually resource stocks. The other ones are oil, gas, weed, whatever. But this just gives you a sense that, going into this fall period, there was a bottom in July, but it's not much of a move. It's been very, very specific. And it's generally been a relatively small number of fairly successful explorers and some of the companies in their environs. I mean, Golden Triangle is sort of one obvious area play, if you want to call it that. But it definitely has not been the broad move that we've seen. Because normally with these stocks, if we get back into, and we will, a market where you really see broad moves in a lot of stocks, you won't see that index move the way it has the last month. It'll look a lot more like it did at the end of last year, actually, where it'll do a 20% move in a couple of weeks, because these are stocks that can easily do that even as a group. We're not there yet, obviously. It's a very selective move. What's driving it? I mean, there's a lot of things doing it. I mean, I don't like harping as much on the US dollar as everybody does. I'm not that comfortable with the concept, and never have been, that gold's simply the anti-dollar. It's not that simple an equation. There's a lot of reasons why both of them get traded. But there's no doubt it's had an impact. And one thing to keep in mind is, one thing that has been frustrating commodity traders, it's been frustrating gold bugs, is when you look at this dollar chart, the US dollar has had a pretty big down move in the last 9 months. If gold was, literally exactly 100% the anti-dollar, it should be sitting about $1,400 right now. So, I mean, if I'm a gold trader, and that's what I mean when I say the move over 1,300 was almost overdue. I mean, it was definitely getting to the point where I think a lot of guys that are bullish on the gold market, if they hadn't seen that move through 1,300, I think things could have quite likely gotten ugly in the other direction. Because a lot of people that were gold bulls were going like, what the hell is going on? I'm like, how is it I'm looking at a US dollar chart that looks like this and gold's not about $1,300? Like, I'm going to give you part of the reason I think at least why it's happening. But just in terms of the dollar itself and where it might be going, currency trades are never one-sided. They're always two-sided. We saw a fair amount of strength in the euro in the last few months, way more than I'm sure Mario Draghi wants. I don't think he's happy about the fact that euro's at $1.20. He probably hates it. But they have been putting up pretty good numbers by and large. I mean, most of the European economies have put up decent numbers. The ECB's been threatening, hinting, promising maybe that they would actually start unwinding their QE program, and that's helped generate some of the volume. You've also seen, some of the selling in the U.S. I mean, it's been political, because you had the big move at the start of the year, the Trump trade. That's obviously completely unwound, and then some. You also saw a lot of strength in China. In the last 2 months, the Chinese currency has actually been very strong. It's been up about 10% since about the beginning of August. I suspect a lot of that is political. I think Beijing knows they've got a trade fight ahead of them, and I think they are in fact pushing up their own currency because, I mean, they are a mercantilist state. They've never pretended otherwise. They were just fine until recently with their renminbi getting cheaper. But I think they've got concerns about a real fight on the trade front. So, although I think some of it's the normal trade flows and currency flows, I think they're pushing their currency higher because they know it's something they're going to have a fight with the U.S. Congress about. Because there's a lot of guys in the Congress that think they've been pushing it down artificially to improve their terms of trade. So that's probably going to keep going for a while because it's political. Even the Canadian dollar has actually helped on the other side of the trade push U.S. dollar down, because the Bank of Canada did again what the U.S. Fed still hasn't done again, which is raise rates. And why has this not impacted the gold price more? There's a couple of things here, and I'll go through both of them. I mean, when I look at interest rates and what moves the gold price, for me, it's not so much nominal rates; it's real rates. Real rates are what matters when you see what drives this market. You'll notice periods where, if you just look at nominal yields, if you just look at the 10-year yield in the U.S., say, you'll take a look and you look at a recent chart. It had a bounce recently, but it had a similar move down, actually, to the U.S. dollar. It was, again, it was sort of the Trump trade and everything's going to be great and we're going to get all these tax cuts and everything's going to be wonderful. All that stuff unwinding through the early part of the year. If you look at, say, a 10-year yield chart in the US, it's very similar to the US dollar chart, which isn't really surprising when you think that a huge amount of the currency movements internationally is yield chasing. It's guys moving from place to place to place trying to get the best yield for whatever risk level they're willing to endure. But with gold, historically, if you look at the relationship, what really matters is not so much the nominal rate, it's the real rate. And if you look at this chart on this page, what this is it's the core PCE in the US. The PCE it's the personal consumption expenditure deflator, if you want the long term. This is the inflation measure that the Fed Open Market Committee looks at. This is their favorite measure. That's a fairly long-term chart you're looking at, so the part we're interested in is just the right side of it. You see where it's at that big drop from almost 2% down to about 1.4. That's all happened this year. So if you were looking at real interest rates at the start of the year, you would be taking the nominal rate and you'd subtract 2% because that was the core PCE. If you're looking at the same rate now, you would take the nominal rate and you would only subtract 1.4% because that PCE has dropped by 0.6. So even though the nominal yields have dropped, the real interest rates have not actually dropped. In fact, at the short end of the curve, the real rates have gone up. They were going up through most of this summer. That's part of the reason why I think the gold price is getting whacked. You started to see that roll over in the last little while at the long end of the curve, especially because the guys trading the long end of the curve, I mean, they are watching things like these inflation rates. The guys at the short end of the curve, it's dominated by whatever the actual Fed funds rate is. I mean, if the Fed funds rate is 1%, you're not gonna buy one-year bonds up to the point where it's 0.5% yield. I mean, it's rarely going to drop below the official yield unless something's really wrong. So the short end of the curve is kind of nailed to whatever the Fed's got it at. The long end of the curve is moving based on growth expectations and inflation expectations. Those expectations of inflation and, for that matter, Fed rate increases coming off is, I think, what's finally turning gold. Based on what's going on, especially at this inflation chart, because that is the price stability is what the Fed's supposed to be about. The way that's going, they really don't have any reasonable reason to raise rates. So, well, they might do it because they want ammunition for the next recession, for the next rollover. Based on their own criteria, it makes no sense for the Fed to be raising rates. So I think that's going to help the gold price, I think, for the remainder of the year, because I don't see anything coming that's going to change that. I mean, politically, if anything, things are going to get even more sideways. So I just don't see I think it's very unlikely the Fed raises even in December. I don't think there's any chance at all they do it this month. But I think as that gets baked in the cake, I think there is still a bit more room on the upside on gold. And I'm not going to just kind of read through this, but I mean, basically, when you look at those real rates, you look at the market backdrop, gold should have done better, but we are still in a very much a risk-on market. We're not getting the buying that you would get from, say, nervous equity traders and stuff like that. Because if you look in New York, nobody's nervous in New York. I mean, New York, everything is sweetness and light. Nothing could go wrong. Doesn't matter what happens from day to day to day. Like every day, they just come and they buy. I'm not one of these, end of the world gold bug. Oh my God, we're all going to die types. I'm not looking for any kind of nightmare scenario. I don't see anything obvious to me that says we're going to see a crash. I do think the odds are getting pretty high. We're going to see maybe a significant correction though in the near future. I mean, there's a couple of things in particular that I find a bit concerning. Just having watched things for a long time. One is the market breadth seems to be getting worse and worse in New York, and that's generally on any market. What goes first is the market, and the market breadth is how many stocks are going up, how many are going down. And what's happening is more and more, even though the market's continuing to rise, more and more of that rise is concentrated in a smaller and smaller number of companies. Generally, that's not a healthy scenario. I mean, when you see that kind of breadth deterioration, that's usually the first thing. That's usually the first place where you see the cracks appear when you're going to see a big correction, or a small one for that matter. The other thing too, and if you look at where the money flows are coming from the last little while, certainly the last few months, all the inflow has been, mom and pops, if you will. It's been retail. Institutional money, by and large, has been pulling out of the big markets. They've been shifting a lot more to the bond market. That's one of the reasons why the bond bull market seems to refuse to die. We've all been calling the end of the bond bull market for like 5 years now, and it still doesn't happen because the flows are going that way. And I'm not a believer in the whole, institutions are the smart money. I know some really stupid fund managers personally. I do understand that historically, when you see that shift where the big buying coming in is all retail and the selling is institutional, that's also not generally a great sign. I mean, usually that institutional selling is going to overwhelm the retail buying at some point, and at the very least, you'll see a correction. And of course, September, October, it's the time of the year when we usually get those because 'tis the season for that too. In the resource space, we haven't been getting as much risk on, but certainly there have been pockets of it and strong ones. There have been, traders gravitating towards a relatively small number, high profile exploration wins and a few things in their area. It's definitely not general. It's been quite specific. Few areas, a few sets of companies, but those companies are getting quite large amounts of buying. So, I mean, there's no doubt in a general level the market's improved. Like you wouldn't have seen 6 months ago, 9 months ago, I'm not sure you would have seen GT Gold, for instance, react the way that it did. I mean, there's definitely more of that sort of money around than it was a little while ago. So because money's been gravitating to those drill speculations, the ones that have worked and the ones in the hottest areas have done great. You're starting to see that broaden in the sense that we're starting to see more anticipatory buying of early stage exploration stories. I'm happy to see that because that's kind of my bailiwick. That's one half of the type of companies that I follow. And I just want to remind everybody that when you get into that kind of market where things get strong enough, where there's enough money flowing in that you get good speculative moves, good anticipatory buying in a well-told story, usually it's the high-grade ones, seems to be what people are gravitating to right now. You try to get in those things early. When the market gives you a chance to take money off the table, reduce your risk significantly before any drill results are in, and that is what you do, okay? You got to play the odds on this stuff. I mean, I've been trading this stuff a long time. I've done well at it, but I get my head handed to me regularly, but I'm okay. I'm a big boy. I love playing this sector. I know that's going to happen, but I try not to put readers in that position. So if you get in early on something and you get enough of a gain, I think most of my subscribers will tell you that I'm probably quite tedious with them about this, saying it over and over and over again. Like, take money off the table, take your risk down. If you can give yourself a zero cost base on a drill spec, I mean, that's the perfect trade because no matter what happens, you're not going to get hurt. And the other thing that I think that's become a much better buy because of this speculation, because money has moved away from the more developed end of the curve. Some of the companies that are actually, have resources in the ground that are advancing things, a lot of those ones have traded off 10, 15, 20, 25% in the last 2 or 3 months. No bad news out. That's just not where the money's flowing right now, and they've become, relatively speaking, I think, a good buy. It's no coincidence that the 3 companies next to me are the ones that they are. Those were selected intentionally because we are getting towards the end of the northern season. I thought it'd be a good idea to remind you that there are some developed companies on the list that are moving things forward that I think are positioning themselves, certainly in the case of the first couple that you'll hear from, they're positioning themselves in the medium to near future to be takeover candidates. I mean, either of them could be at any time. That's the other side of this market that's a good one to play because it hasn't been attracting the hot money in the last little while. They're pretty good values. So that's the kind of stock that we're going to deal with in the next 20 or 30 minutes. We're going to start with Vendetta. Vendetta is a zinc developer, lead zinc project in Australia. Mike's not allowed to, but I have run, he's not allowed to until it's official, but I have run numbers back of the envelope on this thing, and they're very strong. I mean, it's hard to get across to people when you're looking at a base metal. People don't get excited about base metal projects. Lead zinc, it's not really sexy, but when you look at the actual value per ton of the open pit, I mean, this is sort of the equivalent to a 5 or 6 gram per ton gold open pit. But so they've got work to do, but I think you're going to see these guys moving quite a bit. there'll be another resource soon, and I think early next year they'll start putting economics on this thing. But we're in a zinc bull market, so I think this is a very good story for this market. So Mike Williams is going to walk us through and tell us where they are now and where they're going in the next 6 months.